A choppy trading session today with stocks closing mixed. Investors bracing for the Federal Reserve's announcement coming tomorrow about what it's going to do with interest rates.
Investigators fear aggressive federal tightening will plunge the economy into recession. So joining us now to break some of this down, Scott Martin from Kinsview Wealth Management. We appreciate your time, Scott. Thanks for being here.
Hey guys, how you doing?
Okay, so
better than the markets, I hope.
Yes, well said. So yesterday we talked about how the market officially kind of entered this bear territory. Talk about how things are looking about 24 hours later here with these interest rate hikes. Really, us being on the cusp of those.
Yes, sounds scary and is, Anthony. And we're not too much better off 24 hours after being in a bear market, as the experts say. We have a Federal Reserve meeting coming up tomorrow where the Fed is going to likely hike interest rates by at least 50 basis points. What that means for us, and the Fed has done this already a couple times this year, is that our borrowing costs are going up. So think about our mortgages, think about lending that you get from a bank and so forth, and things that basically cost money when it comes to borrowing for something that you're going to purchase. So effectively, the Federal Reserve does this, our nation's central bank does this to slow down the economy or curb inflation. The problem is they started in this game very late, and inflation has already gotten well ahead of where kind of the Federal Reserve is and their moves on the interest rate cycle. So therefore, it's going to take some time for them to catch up, and that's going to hurt the markets in the meantime, at least for the next few weeks or months.
You know, I don't have to tell you, a lot of people are really nervous right now. More talk of whether or not we are entering a recession. Your thoughts?
Yes, Sally, I think the recession's here. So I would tell people, don't worry about being in a recession or going into one, because we are in one right now.
Boy.
The good news about that is, so the first 2 quarters of the year, meaning starting in January through, say, the end of June, it's probably true that the economy likely contracted, meaning we had shrinking growth, which sounds super exciting, I know. The reality is this, though. It's going to be a probably short-lived recession, and one that's going to be rather shallow. So the sooner we kind of get to the end of it or get through it, I think the better off we're going to be. But that's also why you're seeing the stock market suffer and a lot of your 401k balances going down.
Got it. So there's kind of a peeling off the Band-Aid effect, it sounds like, right now. What's the time frame on this recession, would you say?
I think it's at least a few months.
Okay.
I'd like to think that it's going to be over at the end of June, and it might be with respect to, it might get better in July, August, and September. But the problem is, Anthony, is that we have this kind of bifurcation going on where we have some consumers that are doing very well, taking trips, buying goods and services, and some consumers that are not doing so well because of the cost of inflation, food, energy, gas, of course, and anything that you basically buy at the stores. Everything that I'm buying for my wife and kids these days seems to be 10, 20% higher than it was even a month ago. So we're struggling with some of our purchases, and therefore the economy, which is basically on the back of the consumer these days, needs to recover. And so that consumer, as they see the inflation rising, as we've seen it every month this year, that's hurting their spending power, and therefore it's hurting the economy overall.
Oh, boy. Okay, well, we'll have you back to talk about it again, because we're going to be talking about this for a while. Scott Martin from Kinsview.
Yes, and hopefully we'll have good news. Thank
yeah,
you,
that would be nice. Wouldn't that be a lovely change of pace?
Make it much worse.
Next time, Scott.
Bye, guys.
Thank you.